Hi guys, welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. One of the coolest things about having a YouTube channel is the interactivity and the responses and questions I get from you guys. And today the video is based on a question that I got in a comment from Armed Armadillo. He says, hey, could you do a vid on the iShares All In One ETFs? AOK, AOM, AOR. I'd like to hear your thoughts on those. Thank you for all the work you put in. First of all, thank you, Armadillo, for the question. And to be completely honest, I had never heard of these. So I did a little homework and I found out that what they're actually called is the iShares Asset Allocation Solutions ETFs. And more specifically, the iShares Core Allocation ETFs. Now there's actually 4 of them. They're AOK, AOM, AOR, and AOA. You guys, what these are is actually a fund of funds. What that means is it's one ETF with 7 separate ETFs held as its parts. And it's based on your risk tolerance. So really quickly, you have 4. You have the iShares Core Conservative Allocation ETF, that's ticker symbol AOK. You have the iShares Core Moderate Allocation ETF, ticker symbol AOM. You have the iShares Core Growth Allocation ETF, that's ticker symbol AOR. And then you have the iShares Core Aggressive Allocation ETF, and that's ticker symbol AOA. So let's take a look at what it says. iShares Asset Allocation ETFs, how they're built. Number 1, stocks and bond weights are fixed for each risk profile. Number 2, each fund holds iShares funds as its underlying investments. So rather than having individual stocks, this has individual ETFs, 7 of them, that make up the fund. The weight of each underlying iShares fund is based on the index market capitalization reviews, and the funds get rebalanced semi-annually. So if we take a look at the actual breakdown of the funds, you guys, we see that AOK, which is the conservative version, is 30% in stocks and 70% in bonds. So this is really one where you're probably already in retirement and you're more concerned about conserving what you have than trying to build assets. You guys, these are kind of the same idea as what the Vanguard has, what they call their life strategy funds. So unlike a target retirement fund, which gets more conservative the older you get, these actually have a fixed percentage that doesn't change. So it's based on your risk tolerance. So AOK, obviously, as we said, would be one that you're either in retirement or pretty far into retirement. And your concern is keeping your assets, not trying to build a lot more. If we take a look at AOM, which is the moderate asset allocation, we find that that has only 40% in stocks and again 60% in bonds. In the growth model, AOR, you have 60% in stocks and 40% in bonds. That's still pretty conservative in this day and age, being that bonds really aren't yielding anything. And the aggressive model, ticker AOA, is 80% in stocks and 20% in bonds. And if we look even deeper into the way it's broken down, we can see that the 7 different ETFs that make up these funds are the iShares Core S&P 500 ETF, ticker IVV, the iShares Mid Cap ETF, ticker IJH, the iShares Core S&P Small Cap ETF, ticker IJR, the iShares Core MSCI Emerging Market ETFs, ticker IEMG, so that's your emerging market international stocks. The iShares Core International Developed Markets, ticker IDEV, and that's your developed international, your big international companies. The iShares Core International Aggregate Bond, so that's international bonds. And finally, the iShares Core Total US Dollar Bond Market ETF, ticker IUSB. So that's more going to be weighted towards your American bonds, but a lot in treasuries. So we know that right now bonds aren't paying a whole lot. And if we look at the differences, we can see up here that the breakdowns in the different sectors. AOK, we're looking at about 67% in bonds. AOM, we're looking at about 58%. So pretty close to the numbers they give, right? And remember, this gets rebalanced twice a year. Taking a look back now at the expense ratios and how these funds have performed. So the gross expense ratio for these, you guys, is 0.31%. So 31 basis points. It's kind of expensive for me. I like my ETFs to be 0.2 or lower, but remember, this is an idea where you don't want to invest in multiple funds. You want to buy one ETF and be good to go. So if one of these fits your risk tolerance, it's an easy way to do it with one single fund, right? Taking a look at how we've done over the 1 year, the conservative is even 9.36, which surprises me. Down to the aggressive, got about 12.85%. Over the 5 years, the conservative is about 6.85, which is about where I would expect it, and the aggressive fund is about 10.5%. Since the inception, now you guys, these funds have been around since 2008, so these are coming right out of the end of the Great Recession, right? Since inception, the conservative funds are about 5.91%, so almost 6%. The moderate is about 6.81%. The growth fund is about 8.57%, so what we would expect, right? 8 to 10%. And the aggressive is 10.38%. Now, we know that looking at past performance certainly does not dictate what's going to happen going forward. Remember, there was some time there back at the end of the Great Recession when bond rates were quite up compared to where they are now. Going forward, I wouldn't expect to be getting those returns in the conservative or more conservative models because bonds just aren't paying anything. And if we had any kind of inflation, you know, when inflation goes up, bond rates go down. So what do I think about these? I think if somebody wants to be really hands-off in their portfolio, it could be a good answer for you. Again, I think the first two are way too conservative for most people unless you're already in retirement. Even 60-40 stocks to bonds, that used to be what most people would say, when I retire I want to be about 60-40. Now with bonds paying what they are, my plan is to be more around 75-25, maybe down to 70-30. That's just my opinion. You guys, there's more than one way to do this. But as far as my thoughts on it, I think it's a fairly low cost way to have an all-in-one if you don't want to be involved with your portfolio. And that's what it all comes down to, you guys. Simplicity for a lot of people is a lot easier, and having one simple fund that does everything for you could be a good answer. And iShares, as we know, is the ETF portion of BlackRock, which is the largest investment house on planet Earth. So these are very established funds with good assets under management. So you don't have to worry about these funds going away anytime soon. I like to have a little more complexity. I like to have mine a little bit more dialed to my taste. So for me, this isn't my cup of tea, but certainly doesn't mean it isn't a good option. So I personally would like to thank you, Armed Armadillo, for your question. You guys, if you have questions like these, I really like it, especially when it's something I didn't know, like this. I didn't know about these funds, so it was kind of neat for me to do the research and to find out about them. I hope you got something out of this. If you did, do me a favor, drop me a like. It really helps the algorithm, gets my videos out to a lot more people. If you're not already subscribed, you guys, hit that red button, ring the bell. You get notified every time I make a video. I know the title says Firefighters Financial Toolbox, but I feel I can help anybody with financial questions out there. So subscribe, check it out. We'll see you on the next video. Thanks a lot.